Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. The Morningstar Investment Conference for Investment Professionals will be held virtually this year on September 16th and 17th. We're offering the same research, analysis, and insight for investment professionals you'd get at the live event for a reduced price of $149. And the best part is, you can join us from wherever you are. For more information or to register, visit go.morningstar.com/MIC. Again, that website is go.morningstar.com/MIC. In this week's podcast, we discuss 3 stocks our analysts have removed from their list of high-conviction picks. We explain why these undervalued utilities offer investors opportunity for capital appreciation and yield. Christine Benz explores which bonds are the right fit for retirees today. And Alex Bryan addresses the role Treasuries should play in a portfolio even when yields are low. So let's get started. We discuss 3 stocks our analysts have removed from their list of high-conviction picks. Early in July, Morningstar's equity analysts updated their list of high-conviction picks. 3 of the stocks cut from the list were BioMarin Pharmaceutical, Caterpillar, and Intercept. We removed BioMarin from the list because of share appreciation. BioMarin's orphan drug portfolio and strong late-stage pipeline continue to support a narrow moat, but we think the market has recognized the full potential of the firm's late-stage pipeline in hemophilia and achondroplasia, with 2 potential drugs launching by 2021. While we believe Caterpillar has the opportunity to increase its high-margin service revenue, its current trading price is sufficiently close to our fair value estimate that we removed it from our picks list. Investors have largely incorporated potential upside from future stimulus packages that may include significant infrastructure spending. COVID-19 has aggravated a cautious capital investment environment that may persist into 2021, creating near-term headwinds for equipment manufacturers as their customers hold off on large purchases while the economy recovers. Lastly, we removed Intercept from the list after the U.S. Food and Drug Administration issued a complete response letter indicating that the firm's leading drug candidate for the treatment of NASH isn't ready for approval. That cuts into any potential first-mover advantage, which was fundamental to our thesis on the stock. We've therefore lowered our fair value estimate for the stock and no longer consider it a high-conviction idea. 6 days a week, we deliver the latest news for investors. Just say, "Alexa, enable the Morningstar skill," or visit morningstar.com/Alexa. Now, Susan Jabinski of Morningstar Inc. highlights dividend opportunities in utilities.
All conventional metrics for valuing utilities using earnings, book value, and dividend yield have come down from the record peaks reached earlier this year. We think the following utilities offer investors an opportunity for capital appreciation and yield well above the peer group. Edison International will always contend with California political risk. However, California's progressive energy policies also create more growth opportunities than most other U.S. utilities have. Edison's electric-only business, recent regulatory success, and $5 billion annual investment plan give us confidence that the company can increase earnings 6% annually beyond 2020. Edison has stakeholder support to harden the grid against natural disasters, integrate renewable energy, and support electric vehicle adoption. Now with the stock trading at a sizable discount to its peers and offering a nearly 5% yield, Edison offers a triple play of value, growth, and income. We think Duke Energy's valuation discount to peers is unjustified, given the company's favorable regulation and investment opportunities that support consistent earnings and dividend growth. Florida remains one of the most constructive regulatory jurisdictions, with sector-leading allowed returns on equity, automatic rate base adjustments, and strong growth investment potential. North Carolina continues to support Duke's growth investments in electric and gas transmission and distribution infrastructure. South Carolina's recent rate-setting decision was disappointing, but we think Duke has enough growth in the state to compensate. With the Atlantic Pipeline Coast Pipeline canceled, management can now focus on executing its sizable regulated growth opportunities. Lastly, Southern is undergoing one of the most dramatic transformations in the usually stodgy world of regulated utilities. In 2000, almost 80% of electricity sold to customers was generated using coal. We estimate it will be less than 20% by 2030. And the company recently announced a goal of low and no carbon generation by 2050 that will probably require the closure of the remaining coal plants. Nuclear, natural gas, and renewable energy are all increasing their share of generation. Southern has been providing investors with annual dividend increases of 3 to 3.5% for the past 10 years, and we expect increases to continue at about this rate.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Susan Jabinski and Christine Benz from Morningstar Inc. explore which bonds are the right fit for retirees today.
Hi, I'm Susan Jabinski with Morningstar. Bond yields are very low right now, but bonds have proven to be decent diversifiers in stock market turbulence. So retirees may be wondering, what type of bonds should I have in my portfolio today? Joining me to explore that topic is Christine Benz. Christine is Morningstar's Director of Personal Finance. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, let's talk a little bit about the bond market environment today. Yields certainly aren't attractive, but you don't necessarily think that's a reason to toss the entire asset class overboard.
I don't, and I've been saying this for a while, Susan. I think some reframing is in order with respect to fixed income assets. I think that investors need to get over this idea that they will be big yield or income producers for their portfolio. That ship has sailed over the past decade where we've seen yields really going lower and lower. I think you need to look at bonds as being portfolio stabilizers, sources of cash flow that you can draw upon when your equities are down. So I like the idea of retirees building themselves kind of a bulwark against an equity market shock that consists of cash and bonds for that very reason, that they can be sources of cash flow.
Now, you recently talked to financial planner Jonathan Guyton in one of your podcasts, and during that, he revealed that he's been really using almost exclusively Treasury bonds with his clients because of their diversification value right now. What do you think of that idea?
Yeah, that dovetails with what I was just talking about, because the idea is you're constructing a portfolio for retirement where you'll always have something to draw upon to supply your cash flows. So his thought process there was that we've been through several periods now where we've seen Treasuries outperform really everything else. As you remember, Susan, we were all covering and watching bond funds during the first quarter. We saw a lot of bond fund types tumble even as Treasuries really held their ground. And that was also borne out by this recent research that I've been working on, where I've been examining correlations across different asset classes, essentially looking to see, well, what is the best antidote to stock market weakness? And indeed, when we look at the asset class that is among the least correlated with stocks, it is Treasury bonds. So that's his basic finding. It's not something that necessarily every financial advisor would support, but his idea is that he's looking to build his clients that bulwark that they can draw upon in periods of equity market weakness.
So given the diversification value of Treasuries, do you think that retirees should be broadening their basket of bond exposure beyond Treasuries?
Well, I like the idea of retirees keeping things pretty simple. And so I do think that you could potentially go with a broader basket of high quality bonds. The key is really high quality. So Treasuries, corporates, some asset-backed and mortgage-backed bonds, I think all make sense as long as the quality is high. And the reason why I would say that many retirees may not want to use a Treasury-only portfolio is that with Treasuries, you pick up quite a bit of duration risk, interest rate sensitivity. So while there aren't any interest rate hikes on the horizon anytime soon, we do tend to see these bond and bond fund types be pretty volatile and be pretty directly affected by changes in interest rates. That's one reason why I would rather see retirees run with a broader basket, whether that's a total market index fund or some sort of high quality intermediate term bond fund. I think is a good core for retirees.
Now, there are a lot of different bond fund categories out there. What are the first steps that retirees should take when trying to figure out what type of bond funds they might need?
I really like the idea of using your anticipated spending horizon to inform what types of bond funds you hold. So, this is the bucket strategy that I often talk about, but basically you're teeing up your cash flows based on your anticipated expenditure from your portfolio. So very near-term expenditures would go in very safe assets. More intermediate term expenditures might go in bonds, and then your very long-term expenditures where you have like a 10-year time horizon can safely go in stocks, because over 10-year increments, stocks have been pretty reliable. So I think time horizon is just a tremendous starting point when thinking about what types of bonds to own.
So if your time horizon is pretty short, if we're talking about that portion of your retirement portfolio that you might need to tap into in the next year, maybe even 2 years, should a retiree be thinking about putting any of that money in a bond fund, or should that be sort of relegated to cash?
Yeah, I think that especially given how close yields are with cash relative to bond funds today, I really don't see a strong case for using bond funds in this context. I like the idea of really, no matter the environment, of retirees holding a couple of years worth of portfolio withdrawals in true cash investments. Yields are really low there as well, but the basic idea is that you're locking down your expenditures. I would not monkey with bonds in this sort of context.
And then let's go a little further out on the horizon, where maybe, okay, so we have that first couple of years of our anticipated expenses sitting in cash. Then now maybe we're looking out 3 to 5 years. So what type of bond funds would a retiree be looking to sort of fill that portion of their portfolio?
Yeah, here I think you can use some sort of a short-term bond fund. Again, I would keep the quality high, because I think you really want to remember why you're holding bonds. You're holding them to be the stabilizers when your equities are down. Anytime you're venturing into lower quality bonds, you're getting more equity-like performance, even a little bit, and you're getting that tendency to move in sympathy with the equity market. So keep quality high. I think short-term for those years just beyond when your cash resources are depleted. And then I think you can venture into intermediate term, high quality bonds for the time horizon beyond that. I like the idea of using a short-term bond index fund or an intermediate-term bond index fund. They are very Treasury heavy and heavy on other types of government bonds. But again, we see that they really do serve as attractive ballast in periods of equity market weakness. There are also some great actively managed funds that investors can use, whether it's a PIMCO Total Return or a Dodge & Cox Income or MetWest Total Return. But bear in mind that those are core plus type bond funds, which means that they will hold a little bit of lower quality bond exposure in exchange for picking up a slightly higher yield.
Let's talk a little bit now about a couple of more specific bond fund categories and whether they're useful in retiree portfolios. You've talked a bit in the past about TIPS funds. What role do you think that particular type of fund has today for retirees?
I do think that retirees should hold Treasury inflation protected securities as a portion of their portfolio. If they're bucketing their portfolios, I hold TIPS in bucket 2, so in sort of that intermediate term portion of the cash flow system. But TIPS do provide that inflation protection, that insulation against an unanticipated jump up in inflation. I've tended to use Vanguard short-term inflation protected securities in my model portfolio. I like that there isn't a lot of interest rate related noise in those products. They're more or less pure inflation protection, and Vanguard has done some research that supports that general idea. But I do think that they are important to retirees, especially because we've seen a lot of spending at the federal level in an effort to stimulate the economy. Inflation is not on the horizon right now, but I think realistically you have to be prepared for potentially some inflationary shock. It may not materialize, but nonetheless I think it's worth inflation adjusting the portion of their portfolios that they have in bonds.
Another sort of subcategory of bond funds are foreign bond funds. And on the equity side, we often talk about the benefits of a globally diversified portfolio. What's your take on foreign bonds and their role in a retiree portfolio, if any?
It gets complicated because there are so many different foreign bond fund types. Most of the research that we've done at Morningstar, as well as some other academic research, would point to, in retirement, the virtue of having currency hedged foreign bond exposure. So to the extent that you own foreign bonds, and you do pick up some modest diversification by owning bonds issued by other countries' governments, you would want to make sure that they are hedged out of the foreign currency, so you're not getting a lot of currency related volatility. I would say that the benefits are extremely modest for retirees who want to keep things simple. It's probably not a must-own category, and it's also important to remember that a lot of the broadly diversified, actively managed bond funds do make room for foreign bonds, so you probably don't need to bolt on an additional holding.
And then lastly, we haven't really touched on some lower quality bond fund types, like an emerging markets bond fund or a floating rate bond fund. Do you think these play a role at all in a retiree portfolio?
Potentially, and retirees naturally like the fact that they have higher yields in an environment where yields are really low today. And these bond fund types were also really beaten up in the first quarter, although they have come back quite a bit recently. So I think to the extent that you incorporate them into your portfolio, I wouldn't include them as part of this shock absorber piece where you've got, your 10 years worth of cash flows. I think of them as the longer term portion of my portfolio. So I'd want to make sure I had a nice long time horizon for them, because when we look at their characteristics, even though they don't go down as much when stocks go down, they do tend to move directionally similar. So I think you'd want to be thinking of them as perhaps equity substitutes as opposed to substitutes for your core fixed income exposure.
Christine, thank you so much for your time today and your guidance on how retirees should be thinking about their bond allocations.
Thank you, Susan.
I'm Susan Jabinski with Morningstar. Thanks for tuning in.
And lastly, Alex Bryant from Morningstar Research Services addresses the role Treasuries should play in a portfolio.
Hi, I'm Christine Benz for Morningstar. With 10-year Treasury bonds yielding less than 1% today, investors may be grappling with what role, if any, these bonds play in a portfolio. Joining me to discuss this topic is Alex Bryant. He's Morningstar's Director of ETF Research in North America. Alex, thank you so much for being here.
Thank you for having me.
So, Alex, let's discuss the first quarter. We saw Treasury bonds really rally, yields declined quite a bit. So let's discuss some of those forces that contributed to those market effects.
Yeah, well, I think there's really two reasons why Treasuries did so well in the first quarter. Number one, investors flocked to Treasuries during the coronavirus sell-off earlier this year due to Treasuries' perceived safety. And then secondly, the Fed has aggressively cut interest rates in order to stimulate the economy. And it tends to do that, cut interest rates, during periods of market turmoil. And when rates go down, that tends to raise the price of Treasury bonds. So I think both of those effects have played into that really strong performance we saw earlier this year.
So how about in the second quarter, when riskier assets rallied, how did Treasuries do then?
So in the second quarter, Treasuries provided a small positive return, but they did underperform the broader U.S. investment-grade bond market because in the second quarter, credit risk was rewarded, so corporate bonds and stocks also tended to do quite well as the market started to rebound. But Treasuries still held up, but just didn't do quite as well as some of those riskier areas of the market.
Okay, so going back to the first quarter, this is one of many periods where we've seen Treasuries really hold their ground quite well in a period where equities are struggling. The question is, with starting yields as low as they are today on Treasuries, I think some investors are reasonably questioning whether that sort of positioning as ballast in investors' portfolios will hold going forward. What's your take on that question?
Well, I think Treasuries can still serve that role as a ballast to equities. They can still diversify equity risk because if the last 10 years have really taught us anything, it's that if you think rates can't go any lower, they always can. There's always a chance the Fed could move rates into negative territory if they need to. But I think the reason why Treasuries offer such a great defensive counterweight to stocks is that they're safer than just about any other alternative, so they're always going to be attractive to investors in risk-off periods. And the second reason I think they work really well as ballast is they tend to rise in price when the Fed cuts rates. And the Fed likely cuts rates when things are bad, when the economy is not doing so well, when stocks aren't doing so well. So even though you're not really getting paid all that much to hold Treasuries, Treasuries can still provide some much needed lift in periods when stocks aren't doing quite as well.
So those low yields, though, do tell us something about what to expect from bonds, from the asset class over the next decade or so. And so let's talk about that, what bonds tell us about what we can expect in terms of total return. And then just talk about the implications for other asset classes as well.
So when the yield to maturity on the 10-year is below 1% as it is now, it's telling you you're not really getting paid much to hold these bonds. Your expected returns are near historic lows. That's very obvious with bonds because they have a published yield to maturity. But it's important to keep in mind that virtually all investments are priced relative to Treasuries. So when yields on Treasuries are low, expected returns on other assets are low as well. We don't see this directly with stocks because they don't have a published yield to maturity, but we do see it indirectly in stock valuations, which are high relative to where they've been historically. That suggests the market has lower expected returns for stocks going forward than it has had for them in the past. So I think that's really important to keep in mind, but there's no question that expected returns today are lower than they were 10 years ago.
So let's talk about Treasuries in a portfolio context. I think some investors might say, well, I don't necessarily want to own a Treasury-only fund, but you don't necessarily have to own a Treasury-only fund to get exposure to Treasuries. So are there any more sort of diffuse ways to obtain Treasury exposure and exposure to other types of bonds as well?
Absolutely. One fund that we really like is Vanguard Total Bond Market ETF, ticker BND. This fund basically provides broad exposure to the U.S. investment-grade bond market, so it includes Treasuries, agency mortgage-backed securities, and corporate investment-grade bonds. Treasuries only represent about 42% of that portfolio, but this is overall is a very conservative portfolio that has almost 2/3 of its assets in bonds that are rated AAA. Its inclusion of corporate bonds and agency mortgage-backed securities allows it to offer higher expected returns than the Treasury-only portfolio, and the additional risk really isn't too bad. But I think this is a really good, solid core bond holding because, one, it's low cost, but secondly, it is fairly conservative. So in periods when stocks haven't done quite as well, this fund has been able to offer some much-needed ballast to a portfolio and has tended to offer a negative correlation with stocks. So I think it will likely continue to offer that diversification relative to stocks. But it's important to have realistic expectations for your bond holdings. They're not going to be able to provide really strong returns as they have over the past decade going forward. It's important to really focus on bonds for the purpose that they're supposed to serve, which is defense. And I think they'll continue to play that, but perhaps with a little bit less upside than in the past.
Okay, Alex, it's always great to get your perspective. Thank you so much for being here.
Thank you for having me.
Thanks for watching. I'm Christine Benz for Morningstar.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.